Hello, my name is Miranda Mizen and I'm a principal at TABB Group. I'd like to take a look at what happened following trading glitch on the London Stock Exchange last week. This glitch meant that about 16 stocks couldn't trade for a while and 6 of them were in the FTSE 100. Now, fair to say there was disappointment by the MTFs that there wasn't a wholesale move to their platform since they were still open for trading. In September 2008, when the LSE had an outage, that perhaps wasn't surprising, but things have changed since then, and I think 4 things are really pertinent here. Firstly, that smart routers are in place. They're well tuned and they're a lot smarter than they were this time last year. They take in data from relevant platforms and they're geared to switching locations and coping with anomalies in the marketplace just in a heartbeat. Secondly, liquidity is fragmented compared with this time last year. And so the MTFs are very much viable places to find liquidity and very much recognized as such. Thirdly, and I think importantly, trading habits have changed. Most traders have adapted well to trading in places that, other than the primary exchange, they're trading on MTFs, and they include trading in the dark in their search for liquidity. And fourthly, best ex policies are in place, and I think they're generally well understood. I think that issues with the post-trade data, commonly referred to as the consolidated tape, may play a part here, but I also think there are several other reasons that I'd like to explore. For the high-frequency traders, such as market makers and arbitrageurs, they are already most likely to be trading on the other platforms. So for them, an outage in one place is a loss of a place to trade rather than a choice that they have to make to move to another platform. But for limit orders looking for liquidity and providing that book activity, it's a different consideration. And there are a couple of those. And the first one is time. For example, how long will the system be down? Is switching to another location automated, or is there a manual element to it? Nobody wants to be caught in the wrong place at the wrong time, particularly when systems come back up. In addition, when you take an order from one place and put it in another, you're likely to be reprioritized at the price. So if you end up reprioritized at the price and the original place, which has perhaps more volume, comes back up, you may be wrong-footed. So that has to be factored into the equation as to whether you actually want to do anything or not. Secondly, time also relates to the execution. How urgent is the execution? Will the overall cost of the trade be the same if I move platforms or trade now as opposed to waiting? And then where do you route the orders to? Is there the same functionality, or does the order actually have to be changed? Is there sufficient volume at the other places, or is there sufficient likelihood of execution? Is the pricing or the clearing a consideration? And who are the participants? That's obviously another consideration, since there are different on every platform. And lastly, I think in this space, there's also a question of the dark activity. If the stock that you're trading also trades in the dark, and the dark is generally, if not usually, linked to the market that is perhaps now unavailable, then there may be no trading in the dark. And that adds to the general unavailability of liquidity and perhaps the discomfort that goes with changing tactics. So if we add all that together, and we add in the fact that we have a marketplace that is still changing, we have competition that's still forming, and a post-trade environment which has to be described as suboptimal, I think, then what actually happened becomes less surprising. But I think over time that will also change. As technology is now prevalent to trading, there are going to be blips and glitches along the way. Things do fall over, however, momentarily. But as liquidity continues to fragment, the impact of individual markets or systems or bits of systems is going to have a lesser effect. And the technology that's in place is going to get smarter and much more adept at switching and making different decisions. That's certainly going to be helped by better visibility in the post-trade environment. But I think at this point, market share is, and probably always will be, the main driver. Thank you.